As we embark on this journey to understand the Federal Reserve's recent decision to cut interest rates, it's essential to reflect on the historical context of such measures. The Fed's choice to lower rates is not without precedent. Historically, the Federal Reserve has used interest rate cuts to navigate through economic challenges. Take the 2008 financial crisis, a time of unprecedented turmoil. During this period, the Federal Reserve implemented aggressive rate cuts to restore confidence and provide liquidity to the financial system. Today, the decision to reduce rates once again highlights the Fed's ongoing effort to address current economic challenges. By examining past instances, we gain insights into the motivations and impacts tied to this policy tool. Such decisions often respond to broader economic indicators, helping to mitigate potential threats to stability. By placing the Fed's actions within their historical framework, we can better appreciate the gravity and significance of this latest move. It's a testament to the enduring strategies central banks employ to safeguard resilience. With this historical backdrop, we set the stage to comprehend the Federal Reserve's rationale in contemporary times, especially with challenges posed by the global pandemic. Moving from history to the present, we will unravel the specifics of their recent decision, exploring its reasoning and potential ramifications in the following segments. The Federal Reserve has made a significant move by cutting the benchmark interest rate for the first time since the COVID-19 pandemic. This decision marks a half percentage point reduction, aiming to navigate economic recovery while maintaining stability. Chairman Jerome Powell emphasized the goal of achieving price stability without causing a spike in unemployment. This strategic cut, while bold, underscores the Fed's vigilance in managing potential slowdowns, not signaling a recession onset. In the pandemic's wake, the economy showed resilience with solid growth and positive indicators. However, concerns about hiring slowdowns and rising unemployment prompted the Fed to act preemptively. The federal funds rate now is within the 4.75 to 5% range, the first major cut since the 2008 crisis, reflecting similar mitigation efforts. The rationale behind this cut lies in managing inflation while ensuring robust job growth. The rate adjustment aims to sustain economic momentum amid global uncertainties and labor market changes. The Fed's dot plot suggests potential further reductions, totaling 2 percentage points by 2025's end. Markets responded with expected volatility post-announcement. The Dow Jones saw an initial rise before stabilizing lower, highlighting investor caution about broader implications. The Fed's decision impacts beyond domestic borders, prompting international central banks to consider similar measures. Tom Porcelli, chief U.S. economist at PGIM Fixed Income, describes this as an atypical big cut, signaling the Fed's determination to steer the economy. Despite solid indicators, labor dynamics and inflationary pressures necessitate decisive actions. The Fed's proactive stance is crucial in countering potential headwinds. Adjusting rates aims to promote sustainable recovery, aligning with stability goals. Future meetings will be pivotal, shaping the U.S. economy and influencing global financial landscapes. Stay informed about upcoming economic updates, as the Fed's actions today lay foundations for tomorrow's environment. Understanding these shifts empowers better decision-making in an evolving economic landscape. In today's economy, the delicate art of balancing inflation and employment is central to the Federal Reserve's strategy. Their recent rate cut, the first since COVID, underscores this intricate act. Despite strong indicators hinting at a robust economy, potential labor market slowdowns loom. Unemployment figures, though steady at 4.2%, forecast to rise to 4.4% as hiring falters. The Federal Reserve aims to preemptively address such concerns. Maintaining employment while managing inflation is a dual approach. Inflation demands nuance. The Fed's goal is clear: stimulate hiring without igniting inflationary pressures that could destabilize markets. It's a challenge to keep the economy vibrant without overheating. The rate cut, cautious yet necessary, seeks to boost confidence in the labor market, encouraging workforce expansion. Chair Jerome Powell emphasized restoring price stability without alarming unemployment spikes, reflecting a broader strategy and commitment to action even when metrics seem reassuring. These decisions ripple across sectors. Businesses recalibrate to this new rate environment, and consumers navigate implications on borrowing costs from credit cards to mortgages. Analysts suggest this atypical big cut isn't a recession harbinger, but a prudent move for maintaining equilibrium. The strategy braces for potential instability while enabling growth. As future Fed meetings approach, close observation is key. Analyst reactions can signal further rate policy shifts. Pursuing stable employment levels and controlled inflation guides ongoing decisions to keep the economy steady. Ultimately, the Fed's actions demonstrate a proactive approach, recognizing stress signs before escalation. In a world of mixed messages, such decisiveness offers a stabilizing force, navigating present and future challenges. Following the Federal Reserve's decision to cut interest rates by 0.5 percentage point, the first since the COVID pandemic, markets responded with mixed signals. Initially, the Dow Jones Industrial Average saw an uptick, showing momentary optimism. However, euphoria was short-lived as the announcement's long-term implications settled. Market volatility highlighted the sensitivity to even minor monetary policy shifts. It's not just Wall Street reacting. The decision's ripples extend globally, reflecting the financial community's awareness of the U.S. Fed's influence. Historically, international banks often align policies with the Fed's shifts to maintain stability. Consequently, reactive measures from global policymakers are emerging, adjusting rates and strategies to this unexpected cut. Such moves are under scrutiny, with central banks in Europe and Asia weighing options. The Bank of England, for example, may reconsider its interest rate paths. Meanwhile, Asian markets, especially in Japan and China, are reassessing policies to remain competitive amid a shifting global landscape. This creates a domino effect, with analysts and investors worldwide revising asset allocations and strategies. This scenario exemplifies our interconnected financial systems. The Fed's move isn't just domestic, it mirrors global economic interdependence. From currency exchanges to commodities, responses vary, shifting like headlines. The psychological impact on investors worldwide is significant. Rate shifts affect borrowing costs, investment strategies, and economic recovery outlooks. With the Fed setting a new tone, the world closely watches, deciphering leaders' words and observing market trends. While immediate effects are navigated, broader implications remain under examination. Understanding this impact requires monitoring further rate movements and global market absorption. What we're witnessing is not just financial reaction, but a comprehensive adjustment as banks, markets, and investors pursue stability amid evolving landscapes. Stay tuned as we cover global shifts shaping future economic landscapes. As we conclude our look at the Federal Reserve's recent actions, it's vital to focus on future interest rate paths. The Federal Reserve's projection, known as the dot plot, outlines a measured path with additional cuts totaling about 2 percentage points by 2025's end. This reflects strategic efforts to bolster resilience in uncertain times. These moves are guided by various indicators, responding to dynamic conditions. The Federal Reserve monitors labor markets, inflation, and global pressures, using such predictions to perform a balancing act. With the federal funds rate between 4.75% and 5%, future flexibility exists. Rationales extend beyond inflation management to navigating labor market complexities. The Fed is attuned to potential unemployment spikes, expected to rise from 4% to 4.4%, and ready to intervene to stabilize employment levels. These projections have repercussions for markets, influencing borrowing costs and investor strategies. As these predictions are digested, ripple effects will be global. Other central banks, watching the Fed's actions, may adjust policies, highlighting today's economic interconnectedness. The Fed's strategy extends beyond numbers, its ongoing market dialogue. Chair Jerome Powell emphasizes decisions aiming to avoid recession and maintain stable prices without triggering unemployment. This reflects a balanced approach seeking growth while mitigating shocks. In closing, these Fed forecasts underscore a pivotal financial history moment, requiring meticulous planning to navigate uncharted waters. Stakeholders, from policymakers to citizens, must stay informed. With shifting conditions, understanding the Fed's intentions provides clarity and foresight. As U.S. monetary policy evolves, it's clear that the future isn't set, but constantly reconsidered. The world watches as the Fed moves cautiously yet purposefully, pursuing its mandate of maximizing employment and maintaining price stability, significantly influencing the global financial landscape. Stay tuned for more updates and analysis of economic and Federal Reserve conditions. Your understanding of these developments empowers informed personal finance and broader strategies.